Over the last several sessions, traders have been forced to navigate violent price swings and extreme market volatility leading into the August 7th trading day. Before we break down the charts, note that this analysis is an educational deconstruction of market structure and trade planning. It is not financial advice. This S&P 500 one-hour chart establishes our baseline. A sudden liquidity vacuum dragged the index down to 7,360, marked by capitulation on these elevated volume bars. Aggressive institutional buying then forced a V-shaped recovery right back to 7,700. This extreme V-shape leaves us with a critical question to answer. We need to determine if this 7,360 level is a true structural floor that establishes a brand new bull run, or merely a temporary bounce before a secondary downward flush. To find that answer, we have to look past the S&P 500 and check the rest of the market to see if other major indices confirm the bounce. This is the one-hour chart of the Tech-heavy Nasdaq 100. Right in the center, we see a massive empty price gap down, followed by a steep and aggressive recovery channel, mirroring the broader market. However, while this tech bounce is aggressive, it leaves a massive overhead supply zone entirely unfilled. Sellers are still positioned above. Moving to the Dow Jones Industrial Average one-hour chart, we check the traditional industrial and cyclical stocks. We see the same macro V-shaped bounce, but we need to pay close attention to the final closing candles on August 6th near the 53,900 level. The Dow's closing structure is notably weaker and less decisive than the aggressive push we just saw in the tech sector. While all major indices share an identical macro V-shape on the surface, this top-level price action is insufficient to confirm a brand new trend. To gauge true institutional conviction, we must look under the hood at internal market breadth. Market breadth measures internal stock participation. It tells us exactly how many individual names are actually buying into the index-level rally. This heat map shows exact S&P 500 sector performance at the August 6th close. From a macro view, it's a highly fragmented, mixed layout of red and green. Look at the mega-cap tech and communication services sectors in the top left, which dictate market direction. There is heavy internal divergence here. Microsoft and Apple managed to close green, but massive heavyweights like Google, Amazon, and Nvidia all closed in the red. Conversely, we see a distinct flow of capital into defensive sectors. Over in the healthcare block, Eli Lilly secured a solid 1.89% positive close. This fragmented, mixed breadth proves the market is hesitating. Institutions aren't blindly buying risk assets. They are rotating capital defensively, preparing for a major unknown event. The question is, what exactly are these institutions defensively positioning for? This is the economic calendar for the week, and the answer lies squarely on Friday, August 7th. At 8:30 a.m. Eastern, we get a cluster of high-impact U.S. dollar data, specifically average hourly earnings, non-farm employment change, and the overall unemployment rate. This employment print carries immense macroeconomic stakes. It is the primary metric the Federal Reserve will use to dictate their upcoming interest rate policy. At exactly 8:30 a.m., algorithmic trading systems react instantly to the numbers. As they pull orders, bid-ask spreads severely widen, instantly draining liquidity from the market and triggering violent, erratic price action. The August 7th employment print is the definitive binary event holding the market hostage. The data will either validate the recent technical floor, or it will act as the catalyst for a massive secondary sell-off. Knowing the catalyst is coming, we transition from macro theory to an actionable, risk-managed execution framework for the session. Returning to the S&P 500 one-hour chart, we zoom in on the rightmost edge to map out our strict technical risk parameters around the current closing price. First, we define the ceiling. There is a critical overhead resistance zone sitting near the 7,760 level. Buyers must definitively conquer this line to confirm a sustained bull trend. Second, we define the floor. The recent V-bottom established a vital swing low support zone near 7,360. If this level fails, the market flushes. The absolute primary rule for executing this plan is simple. Do not attempt to guess or predict the NFP numbers before they drop. Professional risk-adjusted trading requires reacting to the price action after the catalyst hits the wire. We use these precise support and resistance bounds as our strict execution framework. At precisely 8:30 a.m., the rule is to stand aside. The initial data drop is erratic. Wait for the 9:30 a.m. cash open to establish the market's true intended trend. Scenario A is the bullish soft landing. If the data shows solid jobs and stable unemployment, we watch for price action to react positively. To execute this scenario, we wait for a high-volume break above the 7,760 resistance level. Once the breakout clears, we look to enter long positions on the subsequent controlled pullbacks. Scenario B is the bearish recession scare. If unemployment spikes and the jobs data is deeply weak, selling pressure will accelerate. For this bearish scenario, keep a close watch on the 7,360 swing low. If that floor breaks, the V-bounce is entirely invalidated, and downside momentum trades become the active play. A robust trading plan completely removes emotion. By letting the macroeconomic data dictate the technical trend, you preserve capital and ensure calculated execution in an otherwise volatile environment.